Virginie, thank you so much for joining us here at FundForum International. We are living in extraordinary times, both geopolitically and economically. How on earth does this industry navigate them?
I think what's really important is to think about the shorter term, i.e. 1 year, as well as the longer term. Geopolitics are very difficult for asset managers to integrate into their process. They're more like tail risk event. However, when they take the turn that possibly we're seeing now around trade, and when you see that, in fact, the 50 billion is not 50 billion on steel and aluminium, but if you included all the retaliation potential that we have from this trade war, we could reach 475 billion, which is about dollars, which is about 20% of global imports around the world. You could see something quite significant. Because of that significant, I believe that it will not go to that level. I think it's a mutually destructive kind of things. I also think there's an element of political ambition through those trade negotiations around the midterm election. And of course, the midterm election coming in November, hopefully we have that volatile phase, that taper off. Beyond that, I think what we need to really pay attention to on a 10-year basis is how artificial intelligence is going to impact geopolitics. And there what you have to think about is who can really be big in artificial intelligence, because it requires a lot of capital, it requires technology, and also, of course, some kind of vision to implement it. And what I found through my research is that I believe the world is going to become increasingly polarized around two major nations, which of course will have an impact on geopolitics. And those are the US and China. Let me tell you why. First, to be a leader in AI, you need a big data source. And China has the largest internet-based users in the world of over 740 million users. The second thing that you need is capital, and China, like the US, has a lot of capital. Except for China, this goal of being an AI leader by 2035 is really real and is motivated by what I would call some existentialist issues. Meaning that it will provide capital as needed to this industry. Just stepping aside for a minute and talking about those existentialist issues, as you know, China has grown very rapidly, but China has also a very rapidly aging population. So population aging between 2015 and 2050 will be 71%, which is enormous. It's never been faced by any nation to that scale at that level of development before. At the same time, China has a huge pension gap. And the pension gap is estimated to reach the trillions of dollars by 2050 and representing 30% of the whole pension gap by 2050 in the world. And of course, financing that is quite difficult. And of course, the last point is that with artificial intelligence, automation, and robotization, China will be the target of new technologies in the sense that it may take about 50% of its economic activity that is mostly performed by humans right now, which would create a huge issue from an unemployment standpoint. So you put those three things together, we understand that China's target of becoming an AI leader is really a must. And my view is the intention and the purpose that it has around that goal is extremely real and underestimated by many. So if I go back to, we've talked about data, we've talked about capital, we now need to think about technology. And of course there the US is very strong. In fact, China has some weakness in integrated circuits. In terms of processor, it's done a lot of progress recently with supercomputers, but in terms of ICs, it is not at the forefront. And it's tried to develop that since the 90s, and it's not been really successful. The import bill of ICs for China is about $200 billion a year, which is equivalent to its energy bill, which is enormous. So this is, in my view, part of the way that we must think about the trade war. The trade war, in my view, is not really about soybean or steel, although from an electorate standpoint, it is important to President Trump to reach that part of the population, but it is really about technology. And basically slowing down competitive advantage in that race. I think that that means the world will be more polarized around those two big nations. It will create a lot of new opportunities for investors, but also some new risk. And I think we need to be very keen students and open-minded to think about this as investors.
So if we are looking at, as you've described it, a more bipolar world,
Yes.
China versus US, that's going to have knock-on effects to all the other nations that decide whose side they're on, if you like. Too.
Exactly. There's going to be some polarization. This is not to say that Europe and the UK and Germany is not important. It's just the sheer size of the R&D commitment and capital. So what I think may happen as well is alliances. So we should see alliances, say, within Europe or around specific fields. If you think of Japan in particular, because of its economic and demographic issues, Japan has turned towards robotics in a very big way, so it has a competitive advantage there. So there could be additional pulls around specific industries that develop, but in terms of the absolute sheer size of leadership, I think it will be around those two big nations.
And as a result, what can investment managers do to mitigate for that, if you like? And what should they be doing now to combat any of those issues, say, in the next 10 years?
So I think the first thing is to really be open-minded. This is not traditional. This is not like introducing mobile technology, having an IPO, and then getting on that bandwagon as we have seen in the last 15 years. It's part of it is quite qualitative in terms of analysis. It's about sphere of influence. It's about understanding which companies have the vision and the ability to implement a vision to use technology and AI where appropriate. It's understanding the evolution of regulatory frameworks. As we know, in the West, after the Facebook issues, regulatory framework is going to become tighter. It will not be in China. That is my view. So you have to pay attention to, of course, the hard facts, data, like you would normally do when you analyze companies, but also understanding the soft factors and whole the ecosystem and the interdependence that you see within governments, economies, and companies on an ongoing basis.
And that requires the right people in your team too, doesn't it?
Exactly. So I think you want to get expertise around AI. In my view, artificial intelligence will become a more and more important engine or core skill of any asset management firm. Not only to manage their own business better, but also to give tools to fundamental analysts to help them look at the news, look at cluster of information in any languages, to help them as well, of course, as in the quantitative space, becoming much more sophisticated quant strategies.
And to understand the cultural demands in all those different geographies too.
Exactly, I think, and there what's really interesting with AI means localization. So Palo Alto and California, of course, are still an ecosystem of excellence for technology. But once you have machine learning, it's possible that you can excel in a particular area without being part of that ecosystem by just feeding machines information point that it then learns upon itself. Now, of course, the network that you have in big centers like California are important, but China is also creating some centers, as is the UK, for example, or France for that matter, or Germany here in Berlin, trying to develop the ecosystem. But let's remember, AI is about localization as well.
Thank you so much for joining us. It's been fascinating to hear your insights. Thank you.
Thank you.